14. Okay, can everyone see that? I'm really glad this is an interactive class, okay?
Yes,
All right, thank you very much. Is anybody interactive this morning? All right.
Yes.
All right. Now, you know, in the old days when I was taking CPA review, we actually spoke to each other, okay? And we asked questions in the classroom, all right? We believe you can still talk to each other, okay? All right, but you have a question, just ask me what the question is, and I'll answer it as we're going along here. All right, now, the first blueprint says, this is the AICPA's blueprints, calculate the interest expense attributable to notes and bonds payable. All right, now what we're going to talk about is interest expense as it relates to bonds payable that's reported in the financial statements, including discounts, premiums, or debt issuance costs. And also calculate the carrying amount of the bonds payable and prepare journal entries. And you'll see with a lot of these blueprints, you have to know the journal entries, all right? Now, first of all, we're gonna show you where bonds are issued at a discount or a premium. And to determine that, all right, what we do is we look at two rates. We look at the coupon rate. Sonny, can you bring that up? Coupon rate?
You're up.
All right, and the market rate, which is also known as the yield rate. All right, now the coupon rate is also called your stated rate. All right, the stated rate is the actual interest amount that you will receive, all right, if you buy bonds. You're the investor. But we're going to be covering this today, the corporations that issue the bonds, which means they have a bonds payable and a bond discount or premium. All right, so the stated rate, let's assume it's 6%. All right, now, in order to determine how much this interest is paid, you take the stated rate times the what? Anybody? What do you do? Come on, tell me. At the exam, you're going to have to answer. What do you multiply by?
The face value.
Face value of the bonds. Very good. All right. Stated rate times face value of the bonds. All right. We'll give you the interest for a year, right? All right. But if they pay interest semi-annually, your semi-annual interest payment will be 3%. All right. And you have to look at the number of periods. We'll talk about that in a second. But actually, you're paying 3% every 6 months. All right. If you multiply that by the face amount of bonds, it'll tell you how much you pay every 6 months. Now, the market rate, also known as the yield rate, is the rate that similar bonds are paying on the market. So, all right, you pay 6% a year, but similar bonds pay 7%. Now, are you paying a better rate than the market rate? Yes or no?
Yes.
No.
What are you paying to your bondholders? What rate?
6%.
All right. Now, other bonds are paying 7% on the market. All right. All right. So are you paying as good a rate as other bonds are paying?
No.
No. So if you're not paying as good a rate as the market, then you're going to have to issue the bonds at a what? Discount or premium?
Discount?
Premium.
Premium. All right. Why would you be entitled to a premium if we're only paying 6%, all right, and every other bond which is similar is paying 7%, all right? We're going to have to issue it at a discount. Do you understand that? Yes or no? And by issuing it at a discount, all right, when you take the discount plus the interest payments, all right, it makes your rate equal to the yield rate or the market rate. That's why you issue it at a discount. All right. Has everyone got that? Yes or no?
Yes.
Yes. All right. Now, let's go to page 2H15. Sonny, 2H15. All right. Now, let's talk about valuations of bonds. And by the way, we'll be doing questions also. All right. Now, it says here, bonds are valued at the following. To determine the issue price of bonds, you're going to take the present value of the principal of the bonds, all right? And also, you're going to take the present value of the interest payments of the bonds. Those two amounts added together should give you the issue price. Now, here's an example, all right? We have $100,000 5-year bonds issued January 1st, 2020 with a face or stated interest rate, okay? All right, stated rate, coupon rate, that's the rate you're actually paying on the bonds, all right? Now, semi-annual payments of interest are paid on June 30th and December 31st, all right? Now, notice what it says here, all right? Under the calculation of 5,000, it says for bonds with semi-annual interest payments, in order to determine the value of the bond, you have to multiply the number of periods by 2. Do you see that? All right. And divide by the market rate by 2 in order to choose the present value table. All right. Now, let's look at an example of how we would calculate the valuation of a bond, all right, which is equal at par or face value. All right. First of all, when are we selling the bonds? Today or in 10 years?
10 years?
We're selling the bonds in 10 years?
Oh, no,
Why
no,
do
we
we-
sell it today, I'm sorry.
Today, we need the money today, don't we? Right?
Yeah.
If we wait 10 years, what's going to happen? All right. We'll be on the bread line. All right. With other bankrupt corporations. All right. So remember, you're selling two things today. You're selling the face amount of the bonds today, and you're also selling the interest payments that you're going to pay throughout the bond. And you want to figure out what those interest payments are worth today. All right. So when you think about what something is worth today, you think of what table, right? Present value table or just a compounding table. For example, all right, if I want to determine how much the face amount of the bonds are worth today, all right, which present value table am I going to use? The present value of $1 or the present value of an ordinary or annuity due? Which one?
The $1.
Ordinary.
The $1. All right. Remember, the present value $1, all right, gives you the present value of that future amount, the 100,000, and what it is worth today. Okay. Now, when you go to the present value table to get the present value of that 100,000, okay, that's the bond. All right. What do? You go to the present value of $1 table, right?
Mhm.
Now, when you go to those present value tables, there's two things you have to know. What interest rate am I going to use to discount the bonds? And also, how many periods will I actually discount the bonds? Now, let's assume we have this scenario, okay? All right, it shows us here that the present value of the principal at the maturity is 100,000. And also, the present value of the semi-annual interest is 5,000. Now, where do they get the 5,000? All right, first of all, they show you. If you move up, just leave it there, Sonny, don't move up. But if you take the 100,000 times what? The stated rate or coupon rate, that will give you the annual cash payments for interest. But, all right, if you're paying them semi-annually, all right, you're going to pay it on June 30th and December 31st, right? All right, so what are we going to do? When we go to the present value table to get the present value of the 100,000, we use the present value of $1. Now, what rate will we use?
The yield rate.
The
Market-
yield or market rate, right?
Yes.
And if they pay, all right, interest semi-annually, you'll take the yield rate or market rate and take half of that. All right. You understand that?
Yes.
So every 6 months, you're going to give a yield. All right. Now, also, all right, so you take the present value of the, using a market rate of the interest payments. Do you understand that? And
Mhm.
also, all right, forget what I just said. We're going to, the 100,000, we'll take the present value of $1, all right, for the number of periods. So if it's a 5-year bond here, how many periods are we discounting that 100,000 for?
10.
10 periods, 5 years, semi-annual is 10 periods, right? Now, if the yield rate is 10%, all right, what's the yield rate here? Do they tell us?
Yes.
All right. If they do, I don't see it. All right. Now, 10% is a what? The face or stated rate, right?
Yeah.
All right.
Oh, they don't say it.
All right, okay.
Yeah,
All
the
right.
check.
By the way, if
the
there's any
statement-
children there, we must dispose of those children. Okay, all right, so let's go over this. We'll go to the present value of $1 for the 100,000. And we'll take the yield rate, and if it's semi-annually, we'll take half the yield rate for our rate. And, all right, we'll take the number of periods we're paying interest. So if we have 5 years, we pay interest, and it's paid semi-annually, how many periods are you gonna look at to get the factor of $1, the present value of $1? All right, we have 5-year bonds, the interest is paid semi-annually. All right, how many periods are we discounting?
10?
10. All right, so let's go over this. First of all, you want to get the present value of the $100,000. All right, because I'm selling today the promise to pay the present value of $100,000. All right, using, all right, the what? Going to the factor of present value $1, you take what? You take the number of periods you're paying the interest. If they're 5-year semi-annually, you're going to look for 10 periods, right? And if the yield rate was 10%, all right, what rate would you use to get the factor for present value $1? Half of the 10%. Did I say that? Or 5%? All right, now let's look at this example here. All right, it says here, the present value of the face amount is 100,000. Now let me get some facts here. There's a present value of $1 factor, 0.61391. All right, now what is that factor? All right, it's the factor for the present value of $1. All right, now what is the yield rate annually?
It's 10%, huh?
10%, right? Because we always use the yield rate, right? So if the yield rate is 10%,
stated
right,
rate?
and that's the annual rate, semi-annually, every period we're going to yield 5%. Do you see that?
Is the yield rate the same as the stated rate?
Yeah,
Yes.
let me ask you a question. If the yield rate and the stated rate are the same, we're going to issue those bonds at what?
At par.
The market.
At cost.
Par.
At cost.
The face value of the
Face
bonds.
value, yeah,
All right.
but I don't
Hey,
see the yield rate.
well, the yield rate, I'm telling you what it is. It's mentioned, where's the yield rate? All right, don't worry about it. It's got to be given to you, but I'm telling you,
Okay.
the yield rate is 10%, all right? And the coupon rate has to be 10%, okay? Now, once again, we take the 100,000, we multiply the present value factor of $1, all right? We have here 10 periods. It's a 5-year bond. We pay interest semi-annually. So we're going to pay interest for what? 10 periods. And the yield rate is 10% a year. So therefore, for every period we pay interest, all right, this is going to yield us what? 5% annually. All right. Isn't that true?
Yes.
All right.
No.
No.
Semi-annual,
All right.
sorry.
It's going to
5%
yield us
semi-annually.
10% annually. All right. Yield will be 5% semi-annually. Do you see that?
Yes.
So, all right, we get a total of 0.61391. I'll show you examples of this in a second. Now, what else are we promising to give you when we sell you bonds? All right. What do we promise? Is this problem the stated and yield rate the same? All right. How are we issuing these bonds? By the way, please shout out your answer. All right. Because if I have to read every one of these things, we'll never get done. Okay. All right.
These bonds are being issued with the stated rate and the yield rate being the same.
Right. The bonds are being issued at par or face value.
Yes.
That means that the yield rate and the coupon rate are the same.
Yes.
Okay. All right. Now, the next thing we have is we're promising to sell to the bondholder interest, right? All right.
Yes.
We're going to make interest payments to them. All right. For, all right. I forget how many periods it is. Is it 10 periods? All
Yes.
right. And we take our stated rate. Now, how do we get, what is our stated rate for 6 months?
5.
5%.
5%. So 5% of $100,000 gives you the interest payment, right?
Mhm.
All right. Now, we're going to take the present value of an annuity due or an ordinary annuity. If we
Annuity
pay
due.
interest semi-annually, are we paying interest, all the interest for the year on the first day we enter into the agreement? Yes or no?
No.
No. So to get the present value of that 5,000, we're going to use the present value of what? An annuity due table or an ordinary annuity?
Ordinary.
Ordinary annuity, good. And that's 7.72173, okay? Now, for how many periods are we going to take the present value of the interest payments for?
10,
10.
10, right? 10, all right? And what's the yield rate going to be annually?
5.
Annually 10.
Annually, it will be 10%.
Yeah.
The yield rate and the coupon rate are the same, right? 10%, because we're issuing the bonds at face value. All right, you see that? We're paying the same rate that everyone else in the market is paying. So we're going to just sell it at the face amount of the bonds. All right, do you see that? All right, now let's look at, first of all, on page 2H16. 2H16, all right? Now, here's an example we're going to look at, all right? The example says, we're issuing bonds at par value. The contract rate, which is the what? Stated rate is 10%, all right? The market rate or the yield rate is 10%. So without even calculating the price of the bonds, I know the bonds are going to be sold at what?
face value, huh?
Face value, right? What's another term for face value? The par value. Okay. All right. The journal entry on January 1st, when we sell it, is debit cash for $1 million, credit bonds payable for $1 million. Everyone see that? Now,
Yes.
notice, all right, on July 1st, we make interest payments on July 1st and January 1st, right? All right. Now, when are we making our first interest payment?
July 1st, huh?
July 1st. All right. Is that for 6 months?
Yes.
All right. Now, what's the annual coupon rate?
10%.
10%. So the semi-annual coupon rate will be 5%, right?
Yes.
And to get the interest payment, we'll multiply the 5% times the what? The face amount of the bonds or the amount of the bonds at a discount or premium?
The face amount.
Face
of the bond.
value.
Face
Face.
amount. All right. Remember, people out there don't care if you're selling bonds at a discount or premium. All right. They just want to know the bond contract says you're going to pay them a stated rate. All right. Every 6 months. And it's based on the face amount of the bonds. So if your bonds go down in value because you're not paying a comparable rate as the market, all right, the bondholders don't care. All right. They just say, we agreed that you pay me 5% every 6 months, all right, based on the face amount of the bonds, okay? All right, so on these, all right, on July 1st, we debit interest expense for 50,000. That's 5% of $1 million, that's a half a year, and credit cash, all right? Now, on December 31st, you must make an accrual entry because at December 31st, all right, the corporation owes 6 months of interest, right?
Yes.
All right. The corporations had the use of someone's money for 6 months. And how much money have they had that use of? All right. Roughly $1 million.
$1 million.
So therefore, they actually owe at the end of 6 months, all right, 5% of $1 million or what?
50,000.
50,000.
50,000. All right. So what's my interest accrual? Debit
50.
interest expense, credit interest payable. Do you see that?
Yeah.
Now,
Yes.
on the next day, January 1st, because that's the day they pay the interest, July 1st, January 1st, what's your entry? Debit interest payable, credit cash.
Cash.
All right. You see that? It's not hard. And then they show you the T account for the interest payable. Okay. Now, let's go to the next page. Let me see what page I'm on. I want to go to page, all right, 2H7, 2H7,
Wait, 7 or 17?
17. I'm sorry, 17.
Okay.
All right. Now, here's an example of bonds payable issued at a discount. Now, why are we issuing these bonds at a discount? Because the market is paying 12% on the bonds, right? Other bonds are paying 12. We're only paying what rate?
10.
10. All right. So to entice you to buy bonds from us at a lower rate than everyone else is paying, we're going to have to issue those bonds at a what?
Discount.
Discount. Good. All right. Now, COLA issued $1 million, 10%, 30-year bonds on January 1st, 20x14, when the market rate was 12%. Interest is paid semi-annually each July 1st and January 1st for $50,000. All right. So, all right, what do we have here? All right. The interest is what? 10% annually, right? That's the what? The stated rate. Do you agree? All right. And every July 1st and January 1st, we're going to pay how much? 10% of the million or half of that?
Half, huh?
Half.
Half. We'll pay $50,000, right? All right, now let's calculate the amount of the selling price of the bonds. How do you get the selling price of the bonds? Someone tell me, how do you get it?
You got the annuity tables?
What do you take?
Present value of.
What are you selling? What are you selling when you sell bonds? What are you selling?
Cash? But you're trying to get cash.
You're selling cash. Are you selling shekels? Lira? No, you're not selling cash.
You're
All right.
selling-
You're
you're sell-
selling
you're selling
bonds. You're selling a promise to pay an amount in the future, right?
Right.
And also, you're promising to repay what they lent you in so many
You're
words.
receiving cash. Yes.
Right. But what do you, if I buy bonds in your corporation, what are you going to do at the maturity date? Give me back what?
The principal.
The amount of the principal I lent you, right? And also, during the period of that you have the bonds, the use of my funds, you're going to pay me what?
Interest.
Interest, all right?
Interest.
So I'm really selling two things when I issue bonds. The promise to repay the principal, plus the promise to pay interest payments during the life of the bonds. Now, the problem is, the promise to pay the principal is in the what? Future, all right? We're not selling the bonds in the future, we're selling them what? Today, all right? Also, we're promising to pay what in the future? Interest payments, all right? And those interest payments are calculated how much annually? How do you get the interest payments?
Face value times
Face value, yeah.
The rate.
the stated rate.
Rate.
Face amount times stated rate. If they pay interest semi-annually, divide that by 2. So if you get, for example, annually you pay 10,000, then every 6 months you're going to pay 5,000. Okay. All right. So let's see how we do this. All right. First of all, the face amount of the bonds is $1 million, correct? All right. Now we have the present value, 0.03032. All right. What present value table does that come from?
Present value of $1.
Present value of $1. Present value of $1 is always the present value of a lump sum amount. See that? All right. Now, how did I find that 0.03032? All right. I went to the present value of $1 table and I looked at, first of all, a rate and number of periods. Now, how many periods are we going to be paying interest?
60?
60 periods, 30 years, semi-annually. All right. And over every one of those periods, all right, what is that bond going to yield?
6%.
6%. Do you see what you go to? Now, are they going to ask you to memorize all the present value tables? No, but they'll give you the present value of $1. They'll also give you, all right, the compounding amount, which will be the amount of an ordinary annuity. That's the amount from the present to the future. All right. You understand that? All right. You want to use the present value of $1 table. That discounts the $1 million to what it's worth today. All right. Now,
Phil,
yes.
can I ask a question? So are we paying interest at 12% to make up for the discount that we're selling our bonds at, because we're not giving you that?
Right. We're only giving you 10%, right? Everyone else is giving you what rate?
12%.
12%. So we're going to have to give a discount on those bonds of 2%, right?
Right. But I don't
So
see
what's
how the
gonna-
discount. I don't understand the discount. I don't understand how we're giving the discount.
How are we giving a discount?
I don't
Well,
understand it.
what's the
When
yield rate? What's the yield rate? What's the
yield rate-
definition of the yield rate?
That's the market rate of 12%.
Everybody else who has similar bonds are paying 12%, right?
Yes,
All right. But we're only paying what?
10%.
So therefore, we're not giving a rate as good as the market, right?
Right.
So to lure you in, all right, I am not going to be able to get the face amount of the bonds, I'm going to have to sell those bonds at some type of discount.
Cheaper.
Yes.
All right. You understand that?
Yes.
All right. Now the discount is really what percentage? It's 2%, isn't it?
Yes.
All right. It's the difference when the market is paying and what we're paying. So we're going to have to discount those bonds. All right. For 2%.
Thank you first.
I'll give Phil a second. It should unfreeze in a second.
Okay.
Of bonds.
Phil,
But
Phil,
all right,
you
when the
froze
bond-
first. You
Yeah.
froze for a second.
Did I? Did I
Yeah.
freeze?
Yeah.
I don't feel. I'm not cold. That's why.
Well, are you sure? I think I see some snow on your face.
No, I have dermatitis on my face. I do apologize.
No. So,
I guess I don't understand. I think what my issue is that why are we going to the table for 12% if I'm
Because we want to come out to a price that we're going to sell the bonds that will give a yield equal to the market rate. Okay. Do you understand that?
Yes.
So if I have $1 million bonds and I'm going to sell them at a discount, am I going to get $1 million when I issue them? Yes or no?
No.
No. All right.
Okay. Okay.
But at
okay.
maturity, how much am I going to pay you?
$1 million.
$1 million. So the
Okay.
discount is really to make up for the fact that your market rate is lower. Yeah, I'm sorry. Your stated rate is lower than the going market rate.
So the discount comes by them giving you less than the $1 million.
That's exactly right.
Thank
All
you.
right.
Okay.
Okay. Makes
All right.
sense?
Yes. Thank
All
you.
right. So we have the present value of $1 million. All right. And that comes out to $30,320. Now, we also are going to pay semi-annual interest payments. So we're going to go to the present value of an ordinary annuity table, right? All right. And we're going to take the present value of our actual interest payments. All right. What are our actual interest payments on this bond?
12%.
I'm sorry, what was that?
$50,000.
$50,000. Good. All right. But we have to figure out now that 50,000 is paid every 6 months, right? Right.
Yeah.
So it's paid basically today and in the future. All right. But we want to figure out how much that is worth today. The present value of these semi-annual interest payments that we're making over the period of 30 years, all right, is all going into the future. We have to figure out what that's worth today. All right. And we call that discounting. Do you know what present value is called discounting? Yes or no?
Yes.
No, I didn't know.
All right. What are you doing when you take the present value? You're basically taking out the interest that that amount would earn over the period of time. So the present value of the interest payment, $808,066, is what that interest payments are worth today, taking into account that it doesn't include any interest in those amounts. Compounding is what? That's when every payment you keep adding and it keeps
the
getting what?
interest.
The interest is compounded, right? All right.
Mhm.
Now, what is present value? It's the opposite of compounding. All right.
Okay.
And we call that discounting because it takes the interest out. Compounding adds the interest to each payment, right? As they accumulate. And discounting, present value, all right, does what? It discounts it and takes out the
Removes it.
interest, and that's what it's worth today. Okay. All right. Now, what is the factor 16.1612? What is that factor? It's obviously a present value factor, but how did I get that 16.1612? Someone tell me.
That's the present value of a dollar of an ordinary
No.
annuity.
Present value of dollars for a lump sum amount. That would be the $1 million.
I said ordinary annuity.
The present value of an ordinary annuity, all right, for how many periods?
For 60.
60.
60, all right? 30 years, semi-annually, 60 periods. And, all right, we're going to use what rate when we go to that present value table?
The yield.
6%.
The yield rate. And remember, the yield rate was what, 12%?
Yes.
But it's the yield rate every 6 months, all right?
So you have to cut it in half.
So you got to cut it in half. Okay. All right. So when you add the present value of the principal to the present value of the interest payments, that gives you, all right, you're going to get from selling those bonds, $838,386. Do you see that? But
Yes.
what's the face amount of the bonds?
$1 million.
1 million.
1 million. So when you take the face amount of the bonds and subtract the discount of 161,614, all right, what do we call that amount?
The discount.
No,
Amount.
the carrying value. The carrying value. Remember that?
Oh,
Bonds payable minus unamortized discount is carrying value. All right. All right. Now, bonds payable plus unamortized premium is carrying value, I think. And bonds payable less unamortized discount is also carrying value. Now, how do you show the bonds on your financial statements? At what amount?
the carrying.
Carry.
1 million.
Do you show it at the carrying value? The actual individual account bonds payable.
No, you show it at the face amount
Face
of the
value.
You
bond.
show it at the face amount of the bonds, which is 1 million, right? And then you'll subtract the unamortized discount, which is 161,614. So the carrying value, the net, the way it'll show is this, all right? All right, we have bonds payable, always at a million, the face amount, not always at a million, all right? And then you put less unamortized discount, all right, of, in this case, it's what? It's
614.
how much is it? The carrying value is going to be what? 838, right? All right. So what's the discount? How much?
161,614.
161,614, right?
Yeah.
And are we going to add that unamortized discount to the bonds payable or subtract it to get the carrying value?
I'm gonna subtract.
Subtract.
Subtract it. All right. So the bond really, all right, if we had to pay off everyone today, the bondholders, they would get the $1 million less the discount, which is how much?
$838.
838,000. How much?
386.
386. Okay. You with me?
Yeah.
All right. Now,
Wait, Phil, would they get 808,066 or 838? Because the 838, isn't that
all right. If,
interest?
first of all, if I sell the bonds today, how much am I getting? 838,386, right?
Correct.
Is that true? I'm
Right.
getting the present value of the principal and the present value of the interest payments, right?
Right.
All right.
Okay.
Now, that's what I got, 838,386.
Okay.
All right. Now, if I decided, hey, you know what? I have money in my safe, okay, in the back, and I want to just pay off these bonds right today. What am I going to do? I'm going to give them back the 838,386, the carrying value, because we have a bonds payable of $1 million. All right. A contra account to the bonds payable is the unamortized discount or unamortized premium.
Okay.
So if it's a contra account, the bonds payable, that means what? All right. The carrying value is the
Reduced.
net bond payable amount. Do you see that?
Yes.
But on the, when you do the balance sheet, how do you show the bonds and the unamortized discount or premium? What do you show them as? How do you show it? You take the what? You take the face
Bond.
amount of the bonds, right? $1 million, all right? And we would subtract the unamortized discount so that the carrying value is 838,386. Okay? All right. You see that? Now,
Yes.
right below that is an amortization schedule. All right. By the way, has anybody had a bond question asked to them?
What'd you say?
All right. I asked you on the, when you took the, anybody take the financial already?
No.
Has anybody ever taken the financial accounting exam?
No.
Yeah, I did.
Okay,
Yes.
good.
Yes.
Now,
It-
did you have a bond payable, a long-term debt question?
I think so. I don't remember.
Okay, all right. Well, that always happens. All right. 2 seconds after you come out of Prometrics, well, let's not make it that, 5 minutes afterwards, if someone said to you, what were the problems you had, the task-based simulations? You know what they would say? I don't remember.
I remember something.
Okay.
Okay.
All right. Now,
I got the side note board. Is the lease amortization schedule and the bonds amortization schedule, is that pretty much the same?
when you take out a lease, you're actually borrowing the money and using some type of equipment, whatever. Okay.
Okay.
So a lease is considered during the period of the lease, it's a right of use of the lease. All right. But, all right, they look at it as though you're buying it on a conditional sales contract, which means that you're financing the lease payable. All right. Do you understand that?
Yes.
And yes, there is an amortization schedule, all right, for a lease, a finance lease. And what is that amortization schedule? You have the what? The lease payment, right?
Right. Yeah. They have
And then they have the interest component, right?
right. And then
And
you
then
have
and then the difference between the lease payment and the interest is the amortization of the carrying value, right?
right.
Very similar. Yeah, a lease really, when you think about it, people lease equipment for this reason. First of all right, if you lease a car, all right, you're going to go in, let's assume you want to buy a Mercedes, all right, what's going to cost you less, to lease it or to buy it outright?
To buy it outright.
Right.
It's going to be less to buy it outright?
When you add up
No,
everything,
no. A lease is going to be less because if you have a 3-year lease, what happens at the end of the 3 years?
you may have an
You
option to
give
buy.
back
Give it back.
no, you give them back the
Give it
car.
back.
All right. You may not hey, people have 3 5-year leases. At the end of the lease, they want to exchange it and get another or new car. Okay. All right. So at the end of the lease, that car has value. So they determine the lease payments because, all right, at the end of the lease, they want to have some type of residual value. All right. And that's what they're going to sell it for. All right. And then someone will lease it again. All right. So it goes on and on. So lease payments are always less than buying a car outright, because at the end of a car, when you buy it outright, who owns the car?
We do.
You do. All right. And it always has a trade-in value, doesn't it?
Yeah.
Is there any trade-in value on a lease car?
I don't know. Well,
No.
okay.
Go into a dealership, tell them you want to lease a car and say, I'd like a lease where at the end of the lease, you give me a trade-in value. All right. You know what they'll say to you? All right.
Yeah.
You need to stop smoking whatever weed you're smoking. Okay. All right. No.
All
A
right.
lease is you get the benefits of ownership, but also the payments are less because at the end of the lease, you generally give it back. Okay.
Okay.
All right. All right. Now, going back to where we were. All right. You have to do a amortization schedule. All right. To amortize the discount on the bonds. All right. Now, remember, all right, here it is. There are 4 columns to an amortization schedule. You understand that? Now, if you look at this amortization schedule on this page, can you move it up a little, Sonny? Just a little. Stop. Thank you. All right.
Can I ask one question before you start the amortization schedule?
Of course.
So when it comes to the interest rates, the stated rate, is it only used to calculate the interest payment, and that's the only time you use that
The
stated
only
rate?
time you use the stated rate is determine the interest payment.
Okay.
But don't forget, if you pay semi-annually, take the stated rate. Those rates are all annual rates, right? So if you pay interest semi-annually, take the stated rate for a half a year times what amount? What do you multiply it?
The face
Face
of the
amount.
bonds.
Face value of the bonds. Why? Because, all right, I bought a bond from a corporation, all right, and the contract says you're going to pay me every 6 months a certain stated rate, all right, and I don't care if you sold the bonds at a discounted premium. I know that I'm going to get the stated rate times the face amount of the bonds. Okay.
Okay. And
All right,
when I
now,
go to a present value table, I am always going to be using the market rate. Is that right?
yeah, when you
Yes.
take the present value of the interest payments, you'll calculate the actual interest payment, all right? And if it's semi-annually, you'll take the interest payment for a half a year, the stated rate, all right, and multiply it by 2. Do you understand that? So if it's a 30-year, you're going to get interest payments for 60 periods. Do you
So
agree?
that's why I'm confused because, like, since we don't see a present value table here, if
Well,
I
they're
have a
going to get,
present
they would
value
give you the
table,
present value tables.
would I be using the stated rate or the market rate to look up my present value factor?
What do you think?
I think
Mark.
the market rate.
That's correct.
Okay.
Because you're coming up with a price, all right? You're going to sell the bonds. All right. When I come up with this price of 838, 386, you see
Mhm.
that?
Yeah.
All right. What I'm saying is that's the price I'm selling the bonds for. Take into account that at maturity, those bondholders are going to get $1 million, right?
Right.
All right. And that $1 million is basically the difference between what? The carrying value and the what? The face amount of the bonds.
Face amount. Okay.
Do you understand that?
Yes.
All right. So I'm actually giving back to you the interest payments, the
Mhm.
stated interest payments. But remember, the purpose of giving you selling the bonds at a discount is that I want to bring my yield, which is the stated rate, up to the market rate yield.
Yeah.
Do you understand that?
Yep.
So
Okay.
by discounting it and then pay you back, all right, when I sell them to you, I'm going to get 838, 386,
Mhm.
right? All right.
Yes.
But at maturity, how much are you going to get, the bondholder?
$1 million.
$1 million. Now,
Okay.
why is there a difference? Because, all right, you probably during the period of the bonds got a lower interest payment than the yield the market pays. Okay.
Mhm.
But when you go to the present value table, you always use the yield or market rate. All right. And remember, it's a what? Annual rate. So if they don't pay interest annually, but pay it semi-annually, you're going to take that yield rate and divide it by what?
2.
2, half. All right. If it's a 30-year bond and they pay interest semi-annually, how many periods are you dealing with in this amortization schedule?
60.
60. You see that?
Yes.
All right. Now, here's the
Thank you.
amortization. You're very welcome. All right. Here's the amortization schedule. All right. First of all, your first column is the interest payment. Do you see that? Yes or no?
Yes.
All right. The second column is the interest expense. Now, we sold these bonds, the 838, 386, we sold them at a what? A discount. So, all right, I'm going to explain to you why we have these numbers. But we start off with the carrying value of the bonds, okay? Now, in order to get each column, there's a different procedure. In order to get the interest payment, right? In order to get the interest payment, we're going to take what rate here?
The coupon rate.
The coupon or stated rate, which is 5%, times what amount?
1
Base.
1 million. All right. The payment of the interest is the same every period. You see that?
Yes.
Now, the interest expense is the cost we have for carrying the bonds. All right. Now, remember, we really want to give you a yield rate. All right. We want to give you a return equal to the market rate. Okay. All right. So that will be the cost of us, all right, actually borrowing the money from you and returning it to you. That's called our interest expense. Now, the interest expense is made up of 2 things. All right. It's the interest payment plus the amortization of the discounted premium. All right. But interest expense, how do you get the interest expense? All right. First of all, we're going to take the yield rate, all right, for 6 months. All right. And what is our carrying value of the bonds at the end of the first year?
The 838.
838, 386. So, all right, we had a cost of the year of 50,303. Now, let's see what we have here. All right. When you amortize discount, all right, what entry do you make? All right. First of all, if I'm selling the bonds at a discount, all right, I sell the bonds at a discount. What do I pay you at maturity?
The $1 million in this
The
case.
1 million, all right? But I only got up front 838,689, all right? So I actually lost money there, didn't I?
Right.
Because I got 838, but at maturity, I'm going to give you $1 million. All right. Now, what do we call the item called the cost of carrying bonds? Interest expense. All right. So I'm never going to get that discount back, right? All right. And I'm going to amortize the discount because at maturity, all right, the carrying value of the bonds has to be $1 million. Do you understand that? Because that's what I owe at the end of 60 periods. So when you amortize bond discount, ask yourself this: are you, the corporation, ever going to get back that discount?
No.
No, because they're going to be 800 and some odd thousand, but at maturity, you have to pay the bondholders $1 million. All right. So you have to pay them that bond discount. Now, this is actually sort of a deferred cost. Do you see that? All right. Now, because it's a deferred cost, why is it deferred? Because you got 800,000 today, at maturity, you have to pay $1 million, right? So that discount is actually being amortized over the life of the bonds, right? But we use the effective interest method. So let's think about this. If this is a cost, all right, if an unamortized discount, I don't know why I'm writing this again. If an unamortized discount is an additional cost of issuing bonds, when you amortize it, is it going to increase interest expense or decrease it?
Increase.
Increase interest expense. Why? Because I'm getting less money, but in maturity, I have to pay back the face amount. So when you amortize bond discount, you're amortizing an additional cost. Do you understand that?
Yes.
All right. So when you amortize bond discount, this increases your interest expense.
Okay.
All right. Now, what other expense do we have? Well, we have the interest payment. And the interest payment is additional interest expense, isn't it?
Yes.
Right? So if you think about this, when you amortize a discount, all right, your total interest expense will be the amortization of the bond discount plus the actual interest payment. These two are your total interest expense. Now, let's look at the table here. All right, how much was the interest payment for the first period?
50,000.
50,000. All right, how much do we amortize, all right, the discount for the first period?
$303.
$303. So our total interest expense should be $50,303, is it?
Yes.
Yes.
Yes, but you know what? Maybe that's a little too theoretical. So just remember this: the interest expense is calculated by taking the yield rate for 6 months, which is what rate? It's the same rate. What is it? 6%, right? You see that?
Mhm.
All right. You take the yield rate times the carrying value of the bonds. That's the way you get the interest expense. And that's 50,303. The interest payment, which is part of that interest expense, is 50,000. And remember, discount of amortization increases interest expense. Do you see that?
Yes.
So total total amortization amount is this. You take the interest payment minus the interest expense, and that will give you the discount amortization, $303. Do you see that?
Yes.
Now, the bonds were originally issued at a discount. So at maturity, all right, what are you going to pay back?
1 million?
1 million. So we have to go from 838 to $1 million, right? All right. So in order to go from 838 to $1 million, are we going to have to add the discount amortization, all right, to the carrying value? Or are we going to take that 303 and subtract it?
You added.
Add it.
Add it. You see that?
Mhm.
Because the carrying value is increasing. Do you see that? The
Yes.
balance, that's the carrying value. Okay? You see that?
This is my
Yes.
question.
All right. Now, I want to go to a multiple choice with you. All right. All right. And by the way, you have to think a little for this. Okay. It's really not that hard. All right. Let's go to page MCQ 2-30.
Hey, Phil, can I ask you a question?
No. Yes, of course.
Just quick thing. This amortization table is nothing but the effective interest rate method, right?
This is the effective interest rate method, right?
Okay. Okay.
Now, you can amortize discount of premium on a straight line basis, right?
Yes.
So, all right, in the case we just saw, the discount was 161,614. All right, if we do it on a straight line basis, the amount of the discount amortized will be the $161,614 divided by how many periods?
Oh, periods, not years? 60 periods.
60
60
periods.
periods, right?
Yep.
Okay.
All right, and that will give you the same amount each period. All right, now that's if you do what? Use the straight line method. But let's look at, just before we go to the question again, all right, let's think about this. All right, which is more theoretically correct? All right, the cost of carrying the bonds is the interest expense, right?
Yes.
And if you look at your amortization table, the interest expense is increasing, all right, from the first year to the last year, right?
Mhm.
Now, why is the interest expense increasing? Because the carrying value of your bonds payable is increasing. You see that? So your
Yep.
liability is increasing. So it only seems logical that your interest expense is going to go up higher. Does that make sense?
Yep.
All right. All right. So anyway, all right, let's see. All right, we have Q170, and it says on January 2nd, Vol Company issued bonds with a face amount of 480,000 at a discount to yield 10%. All right, the bonds pay interest semi-annually. On June 30th, Vol paid bond interest of $14,400. After Vol recorded amortization of the bond discount of $3,600, the bonds had a carrying amount of $363,600. What amount did Vol receive upon issuing the bonds? All right, now remember, all right, when you issued the bonds, you received the what? The carrying value, right?
Right.
All right, and the carrying value was equal to what?
363,600.
All right, it was, all right, first of all, what's the 363,300 is the carrying value at what date?
Oh, let me go to the problem.
Date he issued the bonds.
After they recorded amortization of the bond discount of 3,600, then, all right, 6 months later, the carrying value was what?
Okay,
At $3,600, huh?
363,600. All right. Now they issued the bonds on January 1st. All right. 6 months later, they amortized it, and then the carrying value, all right, let's go with July 1st, became 363,600. All right. So what was the carrying value? All right. When they issued the bonds. All right. Here's the carrying value. All right. All right. How do you get carrying value? All right. First of all, they issued it at what? A discount?
Yes.
Right. All right. How much was the discount?
I guess 480.
No. What's the total discount?
14. Well, I don't know.
They amortized a bond discount of 3,600, right? Isn't this the amortization of the discount? Yes or no?
Yes.
All right. Now, we know that when bonds are issued at a discount, all right, what do we do to the carrying value, all right, to bring it down to the current carrying value? All right, we actually do what here? We add it, right? Is that true? Right? All right.
Yes.
Now, if the carrying value of July 1st is 363.6 and we amortize $3,600 of the discount, how much was the issue price?
60?
367,200, huh?
All right, it would be $360,000.
360.
Wait.
All right, and why?
Right.
All right, because
Issued at a
here's the
discount.
issue price on January 1st. We amortized some of the discount on July 1st, right? It was $3,600. So remember, I told you, when it's sold at a discount, the amount of the amortization discount increases the carrying value each period. So, all right, if July 1st, the carrying value is 363.6, All right. We go back to January 1st, right?
Right.
And we know the carrying value has to be what? $3,600 less, because when you issued it, you got 360. Your first amortization period increased the carrying value. All right. So that gives you the carrying value at July 1st, which is what date? Wait a minute. No, I'm sorry. This gives you all right. The carrying value of January 1st is what? 360? Yes or no? All right. The 363,600 is the carrying value at July 1st. So what's the carrying value at the issue date? When did they issue it?
January 1st.
January 1st. All right. So here's the value at June 1st. All right. We know when we amortize discount, it increases the prior carrying value. So what we do is we take the carrying value of 363.6, July 1st. All right. Now we added the amortization to the prior carrying value to get the current carrying value. So what do we do? All right. To get the carrying value at actually the date of issue, I'm going to subtract the 3,600 from the 363,600.
So why they just gave that 480,000 just extra information? Huh?
Why did they give that 480,000?
Yeah.
Because the CPA exam, all right, tests you on this. They give you every bit of crap they can, okay? All right. And they expect you to determine what information you need, okay? All right. Now, they could have told you that their controller went out to lunch every day and spent $10. All right. Does that have anything to do with the issuing of the bonds?
No.
No.
Okay.
Okay. Does everyone see that? It's a little tricky, but just remember, when bonds are issued at a discount, right? Every year when you amortize some of that discount, it does what? It increases the carrying value. So that's going from what? Current to the future, right? All right. Near, we're going from what? The future to the what? The date it was issued.
I see it.
Okay.
Yes.
So the 14,400 is just irrelevant information also?
That's irrelevant.
Okay.
Because remember, all right, the issue price has nothing to do with the fact that Vol paid bond interest of 14,400. Okay. All right.
Okay.
To get the carrying value, you need the face amount of the bonds at the issue date.
Mhm.
All right. And you either add or subtract the amount of bond discount or bond premium to get the carrying value.
Okay.
All right. Tell me what's the definition of carrying value. How do you get the carrying value of bonds? What do you start off with? What bonds payable account? What do you start off with?
Bonds payable.
Bonds
Payable.
payable
Face
at what?
amount.
Face
At the
amount.
Face amount.
That's the amount at the issue date, right?
At the
All
issue
right.
date, yes.
Now, if they're sold at a discount, you take the unamortized discount and subtract it from the bonds payable, right?
Right.
All right. If you issue them at a premium, you add the unamortized premium to the bonds payable.
Okay.
Okay.
Yeah.
All right. Now let's go to page 2H18, Sonny. All right. But all right, you had this stuff in school, did you not?
Not like this.
Not like this. All right. What did they give it? Did you use a? Is someone blowing a horn here?
Someone playing an instrument.
All right. That is our band. You know, every big show has a band. Okay. All right. That is Jimmy the tutor. Okay. All right. And his what? Tooting. Who's tooting? Is that another child here? That will be the second child we will remove from the clip. Okay. Go back to that page.
Well,
you want,
I can mute everyone, and Phil, then you'd have to unmute yourself again.
Oh, God. Okay. All right. All right. If anybody knows who's doing that, please, try to, I remember when we had our first child, people said, Phil, how come you didn't have a second child? Well, I didn't want to say to them, kids get on my nerves, that it's not nice. Is that nice? No. So you know what I told them? Well, once you have perfection, you don't want to try for perfection again. All right. You like that? All right. Now let's go to page 2H20. 2H20. All right. And they said you have to know the journal entries, right? All right. Well, here's the journal entries. All right. First of all, this is, all right. All right. These are the journal entries called the issuance of the bond at a premium. Okay. Now the premium, I put that in here. Wait a minute. Hold on one second. Don't go any place. The
2H18, is that?
wait a second. Oh, actually, all right. The premium, all right. If you did this at a discount, all right. Let's go back to all right. The prior page, we issued the bonds at a discount, correct? All right. Now, what would we have debited cash for instead of a premium? If we issued on a discount, what would we debit cash for?
Less
All
than
right,
the
forget it.
50,000.
All right, we'll take this one. This was issued at a premium. Do you see that? Yes or no?
Yeah.
All right. And we have a yield rate of 8% annually and a coupon rate of 10%. Okay. All right. And how do we get this amortization schedule? We determined when we took the present value of the $1 of our face amount of the bonds plus the present value of the interest payments at the yield rate. All right. It gave us a selling price of $1,226,000. All right. $275. Okay. All right. Now, what's the journal entry we would make on the date of issue? It's $1 million bonds. All right. First of all, how much would we debit cash for?
1,226,275.
1,226,275. Okay. All right. See that? All right. Now, the first date, all right, we're going to show is the interest payment. All right. Now let's go back to that amortization schedule. All right. Now, the first date we made a payment, all right, was, you can write this down, it's in the book, July 1st of 2014. So we pay interest on January 1st and July 1st, okay? All right, now, the entry you saw for the debit to cash, 1,226,000, that was on the date of issue. And the date of issue was January 1st. You see that? And they pay interest payments January 1st and normally July 1st. All right, now let's look at the entry we'll make on July 1st, all right, for the actual interest payment of $50,000. You see that? So that number one, all right, is the first payment on July 1st of, all right, 2014. Okay, you with me? You see that? No. All right, now here, tell me what the entry is. You got the figures there? All right. Now the interest payment is how much?
50,000.
50,000. All right. So what do you credit when you make a payment?
You credit cash?
Credit cash. Good. All right. Now we're going to debit interest expense for 49,051. Right.
Right.
And then, all right, the bond premium. This was issued a premium. So when you amortize bond premium, by the way, the normal balance is a credit balance, right? So when you amortize bond premium, you debit bond
Debit.
premium, right, for $949. You see that? And the premium amortization does what to the carrying value?
Reduces it.
Reduces it. All right. Now, if we go back to page 2H20. All right. Here's your entry. All right. There's January 1st when we sold the bonds. All right. And there's the July 1st entry we just made. Okay. All right. You see that? All right. Now, the next thing we're going to do is this. All right. We're going to record the accrual for the interest. Okay. All right. Now, this entry is not quite correct. All right. All right. I'm going to have to change these entries and I'll give you the changes by next time. All right. Now, at December 31st, we have to accrue how many months of interest?
6 months.
6 months.
6 months, right? All right. So if we go to the amortization schedule, all right, what is the interest we would accrue on December 31st of that year? The first
It was
payment was what?
50,000.
No. What was the first payment? The first 50, oh no, okay. All right. What would you debit interest expense for on July 1st? Now, the
49.
amortization schedule, all right, was what? This first one was on the date they issued the bonds, correct? Which was July 1st. Do you agree? Didn't we make this entry? Debit what? Interest expense on
July 1st, yes.
On
July
yeah.
1st.
All right, see July 1st? All right,
Mhm.
we debit interest expense, we debited the premium and credit cash. Now, at the end of December, all right, which would be actually 1 day before the next payment, all right? Now,
Mhm.
Okay.
this entry was made on January 1st, what year? 1,226,000? January 1st, 2014, okay? All right, the first interest payment was made on what date? July 1st, 2014. So we're going to accrue interest on what date? December 31st, 2014. Do you agree? All right. Does everyone agree?
Yeah.
So we go to our amortization schedule. All right. Tell me this. What amounts are the amounts for December 31st, 2014? And the answer is, it would be the amount that's paid the next day, which is January 1st, 2014. Do you agree?
Yes, January 1st, 2015.
Okay, so let's look at this one. All right. First of all, the first item, all right, 50,000, 49,051, 949. That's the interest payment on July 1st. You see that?
Yes.
All right, write down July 1st. Now, the 49,013, all right, is the accrual because the second payment is made on what date? January 1st, 2000 what?
15.
15, okay? All right, so how do you get the accrual? All right, you're gonna make for January 1st, 2015. You're gonna go the day before because that's the date you accrued the interest for the second payment, right?
Mhm. Right.
All right, so at December 31st, year 4, all right, how much is our interest expense for the second item on the amortization schedule? Does everyone understand the second one is the payment on what date? January 1st, 2015. All right, 50,000, 49,013, and the premium amortization. All right, so if that's January 1st, 2015, what's the day before December 1st, December 31st, 2015?
So the day
Did I say that
before-
right? Let me repeat that. All right. On January 1st, 2015, we made the next payment. Do you understand that?
Right.
All right. And that's what payment did they make on the next day?
49.
50,000.
Oh, 50,000.
And the interest expense was 49,013, and they amortized 987. All right. Do you agree? All right. So this is where the error is in the book. All right. Let me, I tell you what, you're going to make, you can cross this out. All right. Let me give you the correct entry. First of all, every time you pay interest or accrue interest, you must amortize your discount or premium. All right. So this is what I'm going to do. All right. I'm going to debit interest expense. All right. For 49,000. All right. $13. Okay. You with me? All right.
Mhm.
Now, I'm going to debit the amortization of the bond premium on that December 31st, all right, which is actually the January 1st, the next day payment. How much is the amortization of the premium?
987.
980.
987, all right? So let's get this correct entry at December 31st. $20.14, okay? All right, we're going to debit interest expense for the interest expense, all right, for the end of 12/31/2014. So that would be the interest expense. That's what, all right? Actually, for the next day, which is 1/1/20x15. All right, how much is the interest expense on 1/1/2015? How much is that? Does anybody know what I'm doing?
49,013.
49,000.
All right, it's 49,013, isn't it?
Yes.
All right, so I'll debit interest expense, 49,013, okay? All right, now I have to amortize the bond premium on this date. Anytime you show that you owe or pay interest, all right, you amortize the premium. All right, so what am I going to do here? I'm going to debit bond premium. How much do I amortize for the bond premium on that date?
987.
987. All right, and then on that date, all right, I will owe interest of how much?
50,000.
50,000? Did I
Yes.
get that right?
Yes.
Yeah, yeah.
Okay,
Yes.
is that 50,000? Okay, so I'll credit, all right, interest
Interest
payable
payable.
of 50,000, right?
Right.
Correct.
All right, let me erase this. All right, now, this is the accrual at December 31st, okay? All right, correct this. It's not the right entry in your book. Do you understand that? All right, now, then 1 day later, which will be January 1st of X5, all right, what are we gonna do on that date? Pay the interest.
Interest
All
payable.
right, so we'll debit interest payable for how much? 50,000.
50,000
And what are we gonna credit?
cash.
Cash. So you want to change the entries, okay? All right, and this is what you'll change in your book. And I'll give you a correct page on this. All right, first of all, on December 31st, all right, you'll debit what? Interest expense for the 49,013. Do you see that? You'll
Yes.
debit bond premium for 987 on 12/31/14, and you'll credit interest payable for 50,000. Then, all right, the next day, January 1st, 2015, you're not going to debit interest payable 50,321. How much you going to debit interest payable for?
50,000.
50,000, right? And what are you going to credit?
Cash.
Cash for 50,000. So cross out that bond discount. All right. Does everyone see the correct entry?
Yes.
Yes.
All right. All right. I apologize for that. You know, when you write these books, you look at these things over and over, the wrong things eventually look correct. All right. Now, this stuff, all right, let me just tell you, this is not easy. And I want to tell you, I don't, we're supposed to have, how many people are still left with us? 25, Sonny?
Yes, that's correct, Phil.
And we started off with what, 50?
No, I think we're up to 27.
Oh, okay. So most of the people stayed on. Now,
Yeah.
actually, we had 50 people who were registered, who bought the book. There was no cost for actually coming to the presentation. All right. But notice how many are left on right now? 26 people, roughly 25 people. All right. Now, the people who basically go off to La La Land, okay, all right, they don't understand. You are getting free information here, all right? If I was studying for the exam and I got free information, all right, I'm not gonna come on and go away and do something else. What are you gonna do? There's no football games, right? All right, there's nothing to do. And what I'm saying is the people that are still here, those are the serious candidates, okay? All right, they're the serious candidates. And you're gonna do better than the people left, all right? And I'll tell you another thing, all right? How many people are here? I know about 7 are our students before. How many people are presently taking, don't tell me your name, how many people are presently taking another course? Just, you know, anybody? Okay, no, that's not me. I'm not taking another course. Okay, all right. By the way, the reason I'm mentioning that is if you look at another course you're taking, all right, they do not incorporate the blueprints in the books, all right? So you're at an advantage here. You have the blueprints in the books. And this is the next thing. Most people don't realize that this exam is competitive, all right? Basically, they're going to actually pass probably 6, you know those passing rates they give? They're such a bunch of garbage, okay? All right, the actual passing rates for a part are maybe 16 or 17%, okay? Now, they will determine how many people they want to pass. All right. And they might want to pass 16% of the people who took financial accounting, maybe during a month. I don't know what that cutoff period is. All right. But, all right, if you're in that top 16%, if you're in the 16%, you will pass the exam. And by the way, the exam is curved. Is everyone aware of that?
So that being said, Phil, they select who they want to pass based on the answers that you, based on your raw score, then they gather the 16%?
Yeah, what they do is, all right, I don't know if anybody, I don't play golf, but I sometimes watch. It's a very fast-paced sport, isn't it? Right? All right, now, all right, now, the first day, is it the first day, if you want to go on to the second day, correct me if I'm wrong, Sonny, all right, you have to get a certain cut score. Is that right?
The first 2 days,
The first 2 days, you have to have a certain cut score, a certain score, all right?
Okay.
Like you have to be at, you know, a 6, below par, whatever. All right. Now, those people who have that raw score, say, all right, 6 below par, all right, they get to go on to the finals, right? The third and the fourth round. All right. Then, all right, those people remaining for the third and fourth round, all right, they will take the top, whatever they want, all right, and they determine it, maybe 16%, 17%, and that will be the people who will pass, and they will convert that to a score, all right?
Mhm.
Now, if you only did, say, 55% correct, that could still be passing, all right? Now, you say, how could that be passing? Well, all right, you don't know what percentage is the passing score. All right. But I can tell you, if they determine that 55% would be a 75, that's a good time to take the exam because you took the exam with a bunch of dummies. All right. Now, and I don't mean that nasty. All right. That's true. All right. Now, when I took the exam, I sat with all the people in Maryland, May, November. All right. Now, I did not go over to everyone at the Baltimore Civic Center and say, you know, actually, we're competing against each other. We know they're going to pass maybe 12%. All right. Let me ask you a question. Are you dumb or smart? All right. I didn't do that. All right. But you could look around the room and see who was sweating. Really, seriously. All right. And all I knew, I sat across from a guy at a round table. There was like a separator. All right. And there was a cost accounting problem having to do with the hospitals and the number of beds they have and how many beds did they have to basically use to break even. All right. I had not a clue what they were talking about. All right. Meanwhile, I could see the guy across from me was actually doing that problem. And he is writing away. I mean, like I couldn't believe it. And he also, we could bring in coffee back then, candy bars, whatever. And he was smoking also. You're allowed to smoke. So he's got a cigarette in his left hand. He smokes the cigarette, all right? On the right hand, he takes the coffee and drinks it, and then puts them down, and then bites into the candy bar. Now you look at that across from someone when you're trying to take an exam, all right? And if they're writing away, all right, you say, God, that must be an easy problem because we all had the same exams. All right. Well, I said at the end when I came out, I said, I saw you were doing that break-even question for hospital beds. I said, you must have known what you were doing. You're writing a ton of schedules. So he said to me, no, I had not a clue what I was doing. I was just rewriting the problem. That's what he was doing.
God.
Okay. All right. So, you know, that was, yeah, he's writing away there. And if hey, you must know what you're doing. And I was going to ask him how you do the problem. All right. So anyway, that's just an interesting fact, which I don't think you found interesting. Okay. By the way, once again, for those who weren't here, all right, we will finish this up, all right, on next Thursday night, 7 to 9. Now, everyone who is here today will get a copy of this video. So you'll get the full copy after I do the second part, okay? Now, also, all right, for those who are here, all right, if you have any questions, even though, all right, you're not my student, I will give you my phone number to call me, okay? All right, and here's my phone number. Please write this down. All right, I live in Maryland. All right, I almost moved to Dallas, but I saw the ice age coming. All right, but anyway, it's area code 301-874-4900, extension 5. 301-874-4900, extension 5. Now, if you have any questions, Monday through Friday, call me anytime you want. All right, Saturday and Sunday, can you call me?
Yes.
Has anybody ever tried to call me Saturday or Sunday?
Mm-mm.
No? All right. And the answer, you can call me on weekends. I answer the phone on weekends. All
I
right.
have called you.
I'm sorry, what was that?
I have called you on a weekend.
Edmund, right?
No, Amit.
Ahmed, I'm sorry. Okay. Yes, we did speak on a weekend. Okay. And of
Yeah.
course, you remember when I called you that day? I said it was a Saturday or Sunday. I said, Ahmed, if you bother me again, I'm going to track you down and beat the hell out of you. Do you remember that?
Yeah.
How's those wounds? You know, because I used a crowbar when I hit him. All right. Did everything heal okay?
Yeah.
Ahmed, did you take the exam that time?
Not yet.
Not
No,
yet.
not yet. Not yet.
When are you taking it?
I'm possibly taking in next 2.5 months.
Why are you waiting so long, if I may ask?
Is, you know, this is the biggest problem with me. I mean, I started with all that horseshoe, then work stuff came up, got busy at
I'm
work
sorry, you started with what? I didn't hear what you said.
with the work.
What'd you start off with? You started off with, then you
I
had
started
to,
with a bang. You know what? I'm going to do this, that, everything. And then somewhere down the line, you know, you make your schedule and one day goes off just because you get committed to work and certain projects comes up and then you lose the track and then, you know, you're off the hook again. So you have to start from square one again. It's like that.
well, how long do you think you have to study for financial if you're working? What would you say? 3 months is all you should study.
Yes,
all right.
yes,
And
yes.
all right, when you start to study again, all right, you'll call me. I'll put you on a schedule. Okay. All right.
Sure.
And all right, you must stick to that schedule. And why are you going for your CPA, Amit?
Well, I'm at such a point in my career where in order to move forward to the next level, I need that knowledge. I need that degree.
So what do you say to yourself every time you're studying and you get tired? All right. Do you look at that goal and say, if I don't start taking that exam and passing it, all right, I'm going to have no flexibility in the future, right?
Yes, that's true.
That's why you're taking the exam. Okay. Just remember that. That's very materialistic, but that's the cold, hard truth.
Yeah,
All right.
it's the hard truth. It's just one time, you know, you just have to focus.
Yeah. And you know what? Honestly, all right, we understand you're busy at work, but you know something? I mean, maybe I'm wrong. You can find time if you want to. All right. And just remember, that's the most important thing, passing that exam. Okay.
Yes,
Please keep that
yes.
in mind. Okay.
Yep,
All right.
yep,
Let's,
thank you.
oh, no, I didn't mean to. Anybody, if you have questions on how to set up a schedule and stick to it, all right, please call me up, honestly. All right, now, the next thing, all right, is I showed you that entries. All right, let's go to, if you would, all right, I'm going to page, bear with me, let me get this book here. All right, I'm going to page, I'm going to, by the way, I'll have those corrections on the bonds, but I want to go to, okay. All right. Do you know how to amortize the discounted premium? Do you know how to do the amortization schedule? And the answer is, if you, all right, you want to test yourself? All right. I'll tell you this, on page 2H19, all right, is the amortization schedule, all right, for bonds issued at a premium. All right. Now, for bonds issued at a discount, all right, look at page 2H17. Now, don't do 60 periods, please. All right. Don't go through 60 periods. All right. All right. Just do maybe 5 or 6 periods and that's it. And then make the journal entries. All right. And if you get that, then you're fine on the amortization. All right. Now, the next thing I want to talk about is, all right, let me see what I have here. All right. let me talk about how the way you show bonds, all right, on a balance sheet. All right. Now, when you have bonds on a balance sheet, all right, this is the way you show it. Obviously, all right, you assume that initially it's a long-term liability, right? Let's assume the bonds are a long-term liability on day one. Now, what you're going to do is this. You will show in the balance sheet, all right, the bonds payable.
What page are we on, Phil?
I'm just mentioning this. Now, I'll
Okay.
all right. Bonds payable would be at the face amount, right? All right. Now, also, you will add to that unamortized premium, or if it's a discount, you subtract unamortized discount. Now, this used to be the carrying value of the bonds.
Phil,
Yes.
you just froze for a second, but you're all right. Go ahead.
All right. This is the carrying value. Now, what about if you have bond issue costs? Printing of the bonds. All right. Bond issue costs used to be shown on the balance sheet as a deferred charge. A deferred charge, and then amortized on a straight line basis over the life of the bonds. All right. So this was like an asset. That changed. And they said that is no longer the rule. The unamortized bond issue costs are a reduction of the carrying value of the bonds. Unamortized bond issue costs. All right. So you keep amortizing the bond issue costs on a straight line basis over the life of the bond. All right. But the amount of unissued bond issue costs is now a what? A reduction of the carrying value of the bonds. All right. So you take the carrying value, bonds payable plus unamortized premium, or subtract unamortized discount. All right. Now, if you have all right. What did I say? If you have if you have bond issue costs that are still not amortized, so this would be not amortized. All right, you're going to amortize these bond issue costs over straight line basis over the life of the bonds. All right, and what you'll do is you'll debit bond issue cost expense and credit bond issue costs. All right, and all right, the amount that's not amortized is a reduction of the carrying value. So actually, bond issue costs are no longer shown as an asset. They're now shown as a contra account to bonds payable. Okay? Does everyone understand that?
Yes.
All right? That's important. Now, let me see where that is. Okay, there. All right, now, the next thing I want to do is go to page 2H23. 2H23. All right, now, we'll be doing a lot of multiple choice, all right, at a certain point. I don't know if we'll get to them today, but you're not going to go out of here not knowing this. All right, now, when bonds retire at maturity, all right, then you have to pay off the face amount of the bonds, right? But you can have bonds which are retired before maturity, all right? Now, let's see what it says about bonds retired before maturity, all right? This is most likely to occur when there's been a significant decline in interest rates below the stated rate paid on the bonds. For example, if bonds are paying 12% and the market rates for comparable debt is 6%, all right, what are you going to do? You'll call back the bonds with the higher interest rate, right? All right, and retire them and then issue new bonds at a lower rate. Do you see that? All right, now it says here, can you go down a little lower? Now, if bonds are callable, the issuer can merely exercise their call option. This might involve the payment of a call premium. Alternatively, they can simply be purchased in the open or secondary market at market rates, regardless of the method of early retirement, a price other than the bond book or carrying value is likely to be paid. And it says here, a gain or loss, usually a gain, will be recorded for the difference between a book carrying value and the market value. All right, now let's look at page 2H24. All right, we have the following here. All right, assume we have bonds that were originally issued at a premium and they're retired early through open market purchase, okay, due to a significant decline in interest rates. So what's happened? The market rates have dropped, okay? All right, our stated rate is much higher. So what am I gonna do? I'm gonna call back those bonds, won't I? Right?
Yes.
All right, you know how you call back bonds? You know how you do that? Bonds, come back. No, but anyway, all right, you're gonna call back higher rate bonds, pay them off, and then issue lower rate bonds. All right, now, the open market purchase in this example, all right, top of page 2H24, all right, occurs on December 31st, 20X1, immediately after the relevant interest payment, and when the market rate for the bonds is 98 or 98% of the face value or stated value or $98,000 based on $100,000 par. All right, so what we have here is the relevant information, all right? And they'll give you this relevant information, all right? They tell you that the book value of the bonds, which is the carrying value, you understand that? All right, is 108, 111. And also, all right, they make semi-annual interest payments on what? June 30th and December 31st, and they're $5,000, all right? And they tell you the interest expense is given. By the way, how do you calculate the interest expense?
The face value times the stated rate. Oh, no, no,
It's
no,
the
no.
carrying value times the market rate.
The carrying value times the market rate, right?
Yeah.
And the difference between the cash interest payment and the interest expense is the premium amortization, all right? Now, because the bonds were issued at a premium, is that going to reduce the carrying value or increase it?
Reduce it.
Reduce it, okay? All right, now here's the journal entry to retire the bonds early on December 31st, 20X1. All right, first of all, the bonds payable are debited for $100,000. You see that? Because that's the face amount of the bonds. And that information is given, all right, actually, if you look at, all right, on the top page 2H23, all right, I'm not going to turn to this, but if you look at the amortization schedule, you see that the face amount of the bonds is 100,000, all right? So, all right, at December 31st, 20X1, all right, they're going to call back the bonds, all right? Now, the bonds have a carrying value of 105,542. So the face amount of the bonds is how much? I'm calling back the bonds. I'm
100,000.
retiring them.
The
What am
face
I
is
going to debit bonds
100,000.
payable for?
100,000.
The face
100,000
value.
100,000 face value. All right. Now, what's the carrying value on the date we retire the bonds?
105, 242.
105,542. So there must be a premium, all right, that is still not be written off. And if now we're retiring the bonds, we're going to write off the remaining unamortized premium. Do you see that? All right. Now, we're buying back the bonds at what amount?
98,000.
98,000.
98,000.
98% of the face value. Do you see that?
Okay.
Yeah.
Okay, on the top? So that's 98,000. So what do you credit? Gain on bonds, 7,242. All right, now how do you get that? If they held the bonds to maturity, they would have to pay the bondholder 105,242 on 12/31/X1, right? Now, on that date, they're calling them back at $98,000, right? So they're getting to repurchase them for less than the carrying value at 12/31/X1, all right? And if you're retiring them at 98,000, instead of still waiting and actually paying them off at 12/31 for the actual carrying value, all right, that would be a loss. Do you see that? All right. If I call the bonds back today, theoretically, all right, I'd have to pay my bondholders $105,242 at 12/31 X1, right? Right?
Right.
All right. But now what am I doing? At 12/31 X1, all right, in the bond contract, it says that I can buy them back at the face amount or the market rate. And it might say you can buy it back at 98% of face value. Okay. By the way, that's stated in the bond contract. Do you know what we call the bond contract?
No.
Isn't a bond a contract? Isn't it a promissory note
Yeah.
between a corporation, all right, and a bondholder? All right. Now, the terms of the bonds are where? They're in the, I think it's called the indenture, isn't it? It's in the indenture.
Contract.
All right. Now, if bonds are secured bonds, all right, we call them secured bonds. But unsecured bonds, which means they're not covered by any collateral, what do we call unsecured bonds? Debentures. Remember that? Or debentures. It depends. Okay. All right. So remember, debentures or debentures are unsecured bonds. All right. So let me go back here a second. All right. We have a carrying value on the bonds at December 31st, X2. All right. If we supposedly paid them off. But, all right, in our bond contract, it says we can buy them back at 98% of the face value of the bonds, which is 98% of 100,000 or 98,000. So buying them back early, what do I have, a gain or a loss?
A gain.
A gain, all right? Now, what type of gain is that? Is that an extraordinary gain or an ordinary gain?
Ordinary. There are no extraordinary gains anymore, right?
It's ordinary gain. There's no longer extraordinary gains anymore
Okay.
or extraordinary losses, okay? All right?
Can I ask a question about
Yeah, of course.
this date? So December 31, 2000 X1, is that necessarily the maturity date or just the date when they realized?
Well,
the
it
market
says
had
that,
changed?
it says assume the bonds originally issued premium retired early through open market purchases, all right? And the open market purchase occurs on December 31st, 20X1. So that, whatever the open market purchase date is, that's the date they're retiring the bonds, calling them
Okay.
back.
Okay,
Okay?
so we don't have to worry about maturity if they don't tell us anything about maturity in the question.
No, maturity is irrelevant. Okay?
Thank you. Yep.
All right.
So
Now,
I have a
yeah.
question about the journal entry.
Go
So
ahead.
the premium on the bonds payable on this journal entry is the unamortized bond that we're removing from the books.
It's the portion of the carrying value of the bond, all right, which is the unamortized premium. So the carrying value is 105,242, all right? Now, that's made up of the face amount of the bonds, which is 100,000, right?
Right.
Plus, there's an unamortized premium, which is a credit balance of 5,242. Do you know why a premium is a credit balance normally? All right. If I sell bonds at a premium, all right, what do I have to pay you back at maturity?
Face amount of the bonds.
The face amount of the bonds. So
Right.
the premium is like an extra little bonus to me, isn't it?
Okay.
All right, which I never have to pay back to the bondholder.
Okay.
All right, so it's really like additional income. All right,
Okay.
well, all right, what do we call the cost of actually carrying bonds? Interest expense. All right, so when we amortize premium, we're reducing our interest expense. Do you see that?
Yes.
Because it's
So
like
the
interest
original-
income.
So the original
Okay.
premium was 8,111, and we're
The
left
original premium was 8,111.
we're left with 5,242 on the date we decide to call these bonds and reissue them at 98%.
We are left with the carrying value of the bonds on December 31st, 20X1, all right, which happens to be the open market purchase date, which means, all right, that's the date we can buy back the bonds.
Okay.
So it says open market purchase.
Yes.
What does that mean? All right, the market is open. You can buy
Okay.
back your bonds on that date.
Okay.
You think they're going to let you just buy back the bonds anytime you want?
Okay.
No, I guess not.
Because remember, the corporation is betting this, all right? They're betting that on that open market date, all right, that the interest rates on the bonds are going to go down. Do you understand that?
Mm-hmm.
All right. So they say to the bondholder, all right, you can buy back bonds on December 31st, 20XO for 98% of whatever the face amount is on that date. Okay?
Is that
Make
for the
sense?
bondholder or the bond issuer that can buy them back?
Well, so far in this chapter, all right, have we been dealing with the bond issuer or the bond investor?
The issuer.
Issuer.
Right?
Because if it was a bond investor, it would be called investment in bonds for the
Okay.
bonds payable.
Okay. Thank you.
Remember, for every liability, there has to be a asset, a receivable, right?
Right. Right.
All right. So if we have bonds payable for 100,000, then the person who invested in my bond is going to have an investment in bonds for 100,000. All right.
Okay.
Now, if I had a premium of 5,242, all right, then the investor would have a debit of 5,242 for premium on bonds.
That which they have paid to the issuer, basically.
The premium on the bonds is when the investor pays more, all right, than the face amount.
Okay.
Now, if I'm an investor, why would I pay more than the face amount? Why would I, as an investor, have a premium?
Because the market is higher than mine, than what I'm selling.
I'm
for?
investing in your bonds. I'm the investor. All right. What's the face amount of the bonds you're offering me?
100,000.
100,000. All right. But you're saying, all right, I am going to sell it to you for 105,242. Do you see that?
Yes.
All right. Now, that's my investment. All right. But at maturity, what am I going to get?
100,000.
Just 100,000. Now, why would I accept that? Why would I pay more than the amount I'm going to get at maturity?
Coupon rate is higher than market rate.
The rate that you are paying me
Okay.
is higher than the yield or market rate.
Okay. Great. All right.
All right.
Same theory then.
Thank
So
you.
what are
Yes.
the bond premium and bond discount? What kind of accounts are?
Well, all right. They are called the contra accounts to the bonds payable. They're contrary. They're the opposite. Like bonds payable, if there's a bond unamortized bond premium, it's a contra. In that case, you would add it to the bonds payable, right? If you had a bonds payable and there's an unamortized discount, it's also contra. Contra means it's against the bond payable account. You see that?
Yes.
All right. And also, remember what I said about unamortized issued costs. They are now contra accounts to bonds payable.
Okay.
All right. So the unamortized bond discount is going to do what to the bonds payable account? Increase it or decrease it?
Decrease it.
Decrease it. Why?
Right.
All right. Bonds payable is a credit, right?
Right.
All right. Bond issue cost is a debit. It's going to reduce it. Okay.
Okay.
All right.
Will,
All
just
right.
clarify about the unamortized premium. So isn't it more accurate to say that it's an adjunct account because it's not a contra like a discount where you pit it against the
Honestly, I've never heard the term adjunct account. Where is that unique to? We generally call these contra accounts, but where did you get?
when you say contra, it's against the normal credit balance of the bonds payable. So now if
Well, no, it's contra means it's against the bonds payable. Against can mean it adds to it. Against to it means it can subtract it. So I think if you look at a textbook, I don't know if they call it a contra. They call it a contra account. All right. Is adjunct something used in another country? I'm just asking. I'm curious.
no,
You know what? I'm gonna look. I'm gonna.
That's what I see.
I'm sorry. Repeat that. I lost you.
In some textbooks, I think that's what they call it. So I just want to clarify if that's also the same as you.
Well, don't worry about it, whether it's adjunct or what did I just say? It's
Contra.
all right, contra. All right. you're just going to show the amount either as a plus or minus. They're not going to say to you, do you put it in the contra account section of the balance sheet? No. All right. It just goes with the carrying value of the bonds.
Right, just a matter of terms. But I have other questions, Phil. For example, if there are two types of bonds, and in terms of presentation, do you lump together if there's a different credit? Sorry, if there's a premium in one and there's a discount in one, or do you present them separately? Where for you to arrive at the carrying.
What you do is you'll take your secured bonds, okay, all right, show them at a discount or premium. And then you'll show the unsecured bonds at a discount or premium. Now, in the notes to the financial statements, you'll probably give detail of what those bonds are by name.
Got it.
All right.
And, right. One last question, Phil. So for retirement of bonds, and you compute for the gain or loss, and if you have an amortized discount, of course, you also close it and you figure it out in the gain or loss, right?
That is correct. If you retire your bonds, you're assuming that any unamortized premium or discount is written off in its entirety.
Okay.
Got it. And if it's just a proportional retirement, then you also compute the proportional percentage of the premium or discount and then amortize.
Right. Yeah. So in this, what you're looking here, all right, if you just retired half of the bonds, you would debit bonds payable for half of the face amount of the bonds. All right. And then you would just debit unamortized premium for half of the unamortized premium.
Okay.
Got it. Thanks so much.
You're welcome. All right.
Can I have one more question, Phil?
Of course.
I'm not
Go
sure
ahead.
if this is relevant or not, but do we have to worry about whether or not the gain is recognized or realized in this situation?
No. In taxation, we have realized and recognized gain. Okay. All right. Generally, in accounting, they'll call it a realized gain.
Okay. Thank you.
Okay. Because realized means an accounting gain. Do you understand that?
Yes.
So like in taxes, you can calculate what you receive and what you give up. All right. And if what you receive exceeds what you give up, that's called a realized gain. All right. Now that's just the difference between what you give up, what you receive and what you give up. But in taxes, there's one further step. How much of that realized gain is recognized on your tax return? All right. We really don't worry about recognized gain on the financial statements. All right.
Okay.
We generally call it, it's realized gains.
Okay. Thank you.
Or losses. Okay. All right. On page 2H26. All right. All right. It says here. All right. Presentation of debt issuance costs. I just wanted you to see this. All right. Page 2H26. Go down a little more, Sonny. Thank you. All right. Debt issuance costs, bond issue costs are to be accounted for as a direct deduction from the carrying amount of the bonds in a similar manner as bond discounts. Amortization of bond issue costs are to be reported as interest expense. All right. That must be something new. I wasn't aware of that. All right. It used to be bond issue costs, but it's shown as interest expense. The amortization is done on a straight line basis over the life of the bonds. All right. Previously, bond issue costs were accounted for as a deferred charge that was amortized on a straight line basis over the life of the bonds. Now, when you look at a bond, all right, if you look at a bond and a bond has a date of, what do I call it? The date of the bond. And also there's the date. I'm sorry. Okay. You will have a date that the bond is dated from. All right. So if the bond is dated from 1/1, all right, 1986, and it's a 20-year bond, all right, you will be able to cash in that bond, get the money back 20 years from this date. All right. So this is the date that's on the issue. It's a date of issue. Now, I want to check these dates. All right. Now, there's also another date on a bond contract called a date of grant. And if I get this wrong, I'll tell you Thursday, a date of grant. Now, remember, bonds can be issued before they're actually sold to the public. Do you understand that? All right. Now, if this is a 5-year bond, all right, we're going to take issue costs and amortize them over 60 months straight line, right? All right. But, all right, let's assume the bond contract is dated January 1st, 86. All right. The bonds mature 20 years from this would be 2016, right? All right. Now, if we sold the bonds on the date of the bond contract, we would amortize the issue costs over 20 years. But they don't always sell the bonds on the date they issue the bonds. All right. All right. They could.
2006.
Is it 2006?
Yes.
You're right. Thank you. All right. Now, what happens if you, the bondholder, buy the bonds on 1988? All right. Now, that's how many years after the bond issue date?
2.
It would be what? Well, all right, let's say it's January 1st of 1986. All right. And you buy them on January 1st of 88. All right. Now, how many months have expired since the date of the bond contract? How much? How many
24
months?
months?
How much?
24 months, huh? 2 years.
24 months. Is that right? All right. All of 86, all of 87. Correct. All right. So 24 months have expired, right?
Yes.
But this bond will come due in 60 months, right? So what do you do as far as the amortization? If you don't sell the bonds on the date the bond contract is issued, all right, then you have to subtract the months you did not own the bond from the date on the bond contract to the date you actually bought them. So if I bought them 24 months after the date of the bond contract, now I'm going to amortize these bond issue costs over 36 months. Has everyone got that? Yes? No?
I think so.
All right, does that make sense? All right, let me see if I can find a quick question. All right, and all right, I have here down 186, 187. Let's go to 186. Multiple choice 186. And that's on MCQ 2-17. All right, MCQ 2-17. All right, let's look at this one. All right, and we have its multiple choice number, what did I say? 186?
Yes.
What the, let me see if I got the
Okay,
right question.
186.
All right, 186, 186.
Next page.
I hope I wrote down the right question. 186, 186. Okay, here we go. All right, 186, MCQ 2-33. I'm sorry, MCQ 2-33. All right, it's question 186. MCQ 2-33. You have two, okay. One more, next page. All right, now let's look at question number 186, okay? The following costs were incurred in connection with the issuance of bonds by Hub Corporation. They had printing and engraving, 5,000, legal and accounting, 100,000, and commissions, all right, that they had to pay to underwriters. How much should be treated as a deferred charge to be amortized over the life of the bonds? What do you say? What's the answer?
I don't know.
First of all, are bond unamortized bond issue costs, are they shown as a deferred charge, or
No,
are they part of the carrying value of the bonds?
their reduction.
The reduction of the
to the carrying
bonds
value.
payable,
So
right?
the answer is A.
The
Zero.
answer is
The answer should be
zero,
zero.
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 Okay, all right.
Right.
How many people fell right into that? All right, now,
Yes.
I didn't
next
fall
thing,
right
what?
into it, but
Yeah, you can go. I'll tell you. Do you remember when I did the leases and I said, all right, how much depreciation does the lessee record when they amortize a finance lease? How much do they, I'm sorry, how much do they depreciate when you amortize the right of use asset? All right, the zero, because you don't depreciate right of use asset, you what? Amortize it, okay? All right, now, I just thought I just want to point out how you got to read these things. All right, 187. The following costs were incurred in connection with the issuance of bonds by Hub Corp, okay? All right, gee, is it the same amounts? Yes, but how much of the bond issue cost will be treated as a deduction of the bonds payable and amortized over the life of the bonds?
Guess 285.
285.
285,000, all right? You see that?
Got it.
All right, now, when we meet next time, all right, first of all, we're going to go over real good areas because we're going to show you, all right, what you do is when you sell bonds, all right, between interest dates, okay, all right. Also, we're going to show you when you sell bonds and they have detachable warrants with them, how much of those bonds go, how much of the proceeds go to the bonds payable, how much goes to the warrants, all right? We'll go over that. That's on page 2H28, okay? And then, all right, we'll talk about long-term notes or mortgages payable. And you know what we may do? We'll do more multiple choice. But I may go into stockholders' equity, if I have time, on 2I1. Do you see that? All right. Now, you see on 2I1, it says prepare journal entries. If you just turn to that a second. All right. 2I1, is it? 2I1. 2I1. All right. Let me just go over. I just want to mention a couple things to you. It says components of stockholders' equity. It's common stock. All right, here it is. Okay. Now, here's a blueprint. This is what you're responsible for knowing when it deals with stockholders' equity. Now, this is not as specific as it could be. Prepare journal entries to recognize equity transactions in the financial statements. All right. Now, can you think of journal entries having to do with equity transactions, like the sale of stock, right?
Yes.
All right. All right. Also, they could give you where, all right, they buy back treasury stock. All right. And there's two methods, the cost method and the par value method. All right. And when you resell treasury stock on cost of par, all right, what do you charge for gain or loss? And the other thing is they can ask you some ratios on that, all right, which we'll talk about. And one of them is the book value per share. You ever heard of that one?
Yes.
What is the ratio of book value per share? What does that tell you? If they just say book value per share, all right, which one are they asking for the value per share? The common stock or the preferred stock?
The common stock?
The common stock. And book value per share normally is this. How much of the stockholders' equity will go to the common stockholders in the event of liquidation? Okay?
Mhm.
All right. Also, we're going to talk about quasi reorganizations. All right. Do you know what a quasi reorganization is?
No.
That's when a corporation has a deficit in their retained earnings.
You doing this at next class?
Well, I'll have time to go into it. Yeah. I don't have to. I could stop.
Go,
I'm asking. I'm asking. I'm asking.
go.
No, but seriously, you know you're going through a quasi reorganization when there's a deficit in the corporation's retained earnings. Now, if there's a deficit in the retained earnings, all right, why might an investor think twice about buying that stock? Because if there's no positive retained earnings, there will be no dividends paid out. All right. So when a company goes through a quasi reorganization, they're eliminating a deficit in retained earnings, bringing it down to zero, All right. And what are they going to use to bring that deficit and retained earnings to zero? They'll
Additional
use some
paid-in
of their additional paid-in capital.
Okay.
All right.
Mhm.
But we're going to go over every, the advantage of the blueprints
You can receive it.
is that, all right, it tells you everything. Okay.
Mhm.
Now, I heard someone say the blueprints, hey, I keep talking about the blueprints. All right. None of the other courses do. So you know what they say? The blueprints are really not what they really ask. All right. They're the minimum they ask. That's not true. That's the maximum they're going to ask. All right. But if you don't have them, you're going to make them sound like, hey, it's not that important. And they are. They're very important. All right. Ladies and gentlemen, I want to thank you very much for attending today. I welcome any new people.